There does appear to be some form of consensus of a cut in growth going forward. Whether that will result in a recession, many are sort of not yet ready to talk about. But a combination of that cutting growth plus what is clearly a substantial reduction in consumer confidence tells us that the majority of our clients are beginning to fix the roof now before it starts raining, in the expectation that tougher times lie ahead.
Good day, everyone. Welcome and thank you for joining today's edition of Teneo Insights. I'm Kevin Kajiwara with Teneo Political Risk Advisory in New York City. So our regular viewers and listeners will know that in recent weeks, our guests have included the likes of Larry Summers and Stephen Ratner, who've raised the specter of a heightened risk of recession as major economies battle increasing inflation, the continuing supply chain dislocations catalyzed by the pandemic, the sanctions and embargo risks stemming from Russia's war on Ukraine. Indeed, the IMF has just cut its global GDP forecast for 2022 to 3.6% from 4.9% as recently as October. All of this, of course, is going to have a profound impact on the operating environment and financial options for corporations. As Summers pointed out, when inflation is over 4% and unemployment under 5%, we in the United States have never not had a recession within the next 2 years. So as we near a potential inflection point, I'm joined today by two of my colleagues who have a wealth of experience counseling CEOs and boards on navigating the challenges thrown up by impending economic downturns as fiscal and monetary authorities struggle to secure a soft landing. So Dan Butters, he is the CEO of Teneo Financial Advisory. Formerly, he was head of restructuring at Deloitte in the United Kingdom. He brought his team, which now numbers 350 globally, here when Teneo bought that business, its largest and most significant acquisition to date. Dan himself has a particular market-leading expertise in the retail sector, and he joins from London today. Jay Goffman is the client chairman of Teneo Financial Advisory. Previously, he was vice chairman, global advisory at Rothschild & Company, and before that, 24 years at the law firm Skadden Arps, where he was global head of the corporate restructuring department, and where he pioneered so-called prepackaged restructurings. He was named American Lawyer's Dealmaker of the Year, and he was one of National Law Journal's most influential lawyers of the decade. He doesn't put in his bio which decade that was, but we can ask him about that. And I should note that before law school, he got his bachelor's degree in chemical psychobiology. So what happened between that and becoming a lawyer is probably the subject of another episode. But gentlemen, and Jay joins me here in New York. Gentlemen, thank you so much for joining today. There's a lot going on. So, I want to start by asking, given the emerging environment that I just laid out there at the start, as you speak to corporate leaders and you speak to board members, what are they thinking about that right now? And what's guiding their current planning? Dan, maybe I can start with you on that.
Thanks, Kevin. Good afternoon, everybody from the UK, and great to be with you all. I think it's fair to say that from a European perspective, this is probably the most complicated environment or outlook that we've faced into, certainly in my time as a professional acting in the restructuring environment. There are literally so many different competing and confusing issues that we are facing into now, both with regard to corporates, financial institutions, governments, regulators, that quite honestly, when we talk to clients, it really is a focus on what is the issue of the day, as opposed to the issues that they've been sort of focusing on over the last 3 months. And I think what is really a consensus view, though, is there is an expectation that there will be some form of downturn in the near future, and we talk about the near future in the context of the next 12 months. There is a lot of data out there with regard to what that might look like. Some of it, as ever, is confusing, but there does appear to be some form of consensus of a a cut in growth going forward. Whether that will result in a recession, many are sort of not yet ready to talk about. But a combination of that cutting growth plus what is clearly a substantial reduction in consumer confidence tells us that the majority of our clients are beginning to fix the roof now before it starts raining, in the expectation that tougher times lie ahead.
Jay, how do you see that as you talk to clients and friends now?
Thanks, Kevin. Look, I think Dan has it exactly right. What I'm hearing is very similar. I'm hearing a nervousness amongst CEOs and boards about where we are in the economic cycle, because I think most people recognize that cycles haven't disappeared forever. We are going to have a recession at some point. I'm not sure there's a consensus yet that a recession is inevitable. I personally think one's coming, but there's certainly not a consensus amongst companies and boards and CEOs. But there is a nervousness, and people are starting to think about what do we do if things take a downturn, with still the hope that things will bounce back. And I actually think it's a good first step, but really not sufficient given where we are in the cycle.
But let me ask you this though, so Dan just said it's a good time to repair the roof before it starts to rain. So let me lean here a bit on both of your experiences, because there's always the temptation, obviously, to prepare to fight the last war. But based on the way things look to be unfolding, what should companies be doing right now? What should they be asking themselves? What should they be arming for, et cetera? I mean, maybe put another way, what should boards be asking of their management teams right now, given where we are, given the uncertainties that you just talked about, but still doesn't look good per se? What's the right action or questions to be doing right now, Jay?
Sure. Look, I actually, that's the most important thing a company should be doing right now. They should be planning all the what-if scenarios. What if the price of fuel stays high? What if Russia cuts off various companies in Europe on gas and oil? What if inflation stays at record numbers? What if the lockdowns in Beijing and Shanghai continue on and the supply chain logistic problems? What happens if it gets worse? What happens if my major customer files for bankruptcy? What happens if my major supplier ends up filing for bankruptcy? What if this takes longer than the previous recessions? And let's say the Fed can't engineer a soft landing like they did in 2008, 2009. What do we do if the price of fuel stays high and the price of money stays high? What do we do if the Fed has to pull liquidity out of the system and keep raising interest rates in order to try to break inflation? What happens if China gets aggressive and decides to go into Taiwan? Those are the what-if scenarios that every company should be thinking about and planning for. Because the one thing I've seen over the last 40 years, as you point out, you shouldn't be fighting the last wars. You should be trying to figure out what's going to happen going forward. But you can learn from history. And one of the things we've seen in history is that when the financial markets shut down, which often happens in recession, it happens very quickly. So even if your business is doing well, if your debt happens to mature during a time period when the financial markets are shut down, you're in a restructuring and not a refinancing, despite how well your company's doing. So those are all the what ifs. It might lead to a situation where a company says, I want to extend my debt, even though it's not due for 2 or 3 years, because I don't know if this next recession is going to last 4 or 5 years, and I want to be prepared to get through it. So if it were me, if I'm a board, if I'm an owner of a company, if I'm a CEO, I'm finding a restructuring professional that I know, that I trust, and I'm beginning those conversations and asking them to help us plan for these what-if scenarios.
So I want to get Dan's view on this as well, but I want to push you just a little bit on, it sounded like what you were advocating for is in a sense is some sort of scenario planning, because you talked about what if this happens, what if that happens, what if, and a lot of these things, I suspect, if the board is asking management about that, management, quite frankly, isn't going to necessarily have those answers. That's why there is this uncertainty out there. And all of those risks that you talked about compound upon each other if they happen simultaneously or consecutively, right? So, So the big scenario is that more than one of those is going to occur, but perhaps not all of them, some combo, and all of those things will impact different companies and different industries in different ways. So on the one hand, you want to make sure your management team is thinking about these things. They're on the table, but what are you wanting them to do now while there is no certainty on the trajectory of any of those risks?
Again, what I would do, I would create a task force within my company, and I'd have 2 or 3 key people, and I'd have an outside advisor or 2 that I really trusted to begin planning these things out. Because as you said, it's usually not, when it happens, it's usually not one event. There's a multiple of things that happen at the same time. Every company that files for Chapter 11 affects 10 others. And so you see these scenarios playing out, and if you've game planned for it, when it happens, you'll know what steps to take to protect yourself. And if you've actually been proactive and thought about it, well, then maybe your company can be better positioned because you've already extended your debt and you've taken these other precautions. And that actually might be a good time to think about acquiring those businesses that didn't properly plan, but who might be a good long-term fit for your business. So again, with all the factors that are there today, higher inflation, supply chain logistics problems, the war in Ukraine going on, higher interest rates going up, liquidity being part of the system, you have to believe that there's a likelihood of some sort of recession. How long it's going to last, who knows? But I would be planning for it, and I'd have a team of people, and essentially I'd put that plan on the shelf. I'd continue to review it and update it from time to time, but I'd be prepared when it hits to move quickly, because the one thing I've seen over 40 years is that when it hits, it happens instantaneously. It takes a long time to get there, but then it just happens. And those companies that haven't thought about it and prepared for it are really left caught short.
So Dan, let me ask that original question back to you. You know, what would you be imploring companies to be doing now or asking themselves now?
Sure. And just in response to that, I'd just pick up on something, Kevin, that you said when you were sort of setting the scene for this, about sort of being prepared to fight the last war. I think it will be really important for corporates, and certainly these are the discussions we're having, is that they do learn from the last war, but they don't assume that it will just be replicated, because this will be very different. And let me explain why. The 2009 was really around the availability of credit and the credit crisis that ensued, and the related implications for asset values as a consequence of that, with particular regard for real estate and real estate related securities, assets, etc. It was short, it was quite painful, but actually when the financial markets were restored, when confidence was regained in the financial and banking system, the emergence from that recession and that downturn was quite rapid. I think this will be very different this time for the following reasons. Actually, what we are focusing on and seeing out there is draining confidence generally, both at corporate and consumer level, with some very specific macro factors that are driving that loss of confidence. And therefore, when we talk to clients about how they should prepare this time round, it is clear that medium-term financing stability will be a factor that corporates need to think about, and that is entirely consistent with what happened in 2009. But there are a number of other factors that will be peculiar to 2022 or 2023 that were not there in 2009. So, for instance, supply chain, which has already been mentioned on this call, that wasn't at all a feature of 2009. It is now one of the top 3 issues that most corporates, will focus upon as they go forward. Secondly, issues in relation to energy and the extent to which they are reliant on the costs associated with energy as an input will be huge issues that they need to deal with. And thirdly, general response to issues associated with Russia and Ukraine, which I'm sure we'll come on to talk about, we weren't dealing with a war in 2009. We are now absolutely dealing with the corporate, financial, political, and candidly, socio-economic issues associated with a major war being fought quite close to Europe. So they are the issues that will need to be dealt with this time round.
And is it fair to so just to pick up on one thing you said there, it seems the assumption out there is that the financial system and the systemic financial institutions in particular are in much more robust condition heading into this than say we were in 2008. And obviously, they're not the causal factor in to the same degree. But is that a fair assessment?
I mean, look, the financial system absolutely through 10 or 15 years of heavy government and regulatory intervention, is certainly in more robust health than it was last time around with regard to levels of capital controls in place both internally and externally from regulators. And there will always be some financial institutions at the edges that will have issues, but that's the case in any environment. We will absolutely have stronger banks, but we will also have a contraction in credit availability because banks, quite rightly, in circumstances like these, will look to protect their own balance sheets and will look to protect the interests of their own shareholders. And that will result in a contraction in credit. And therefore, my observation around the requirement for medium-term financing stability is critical because the landscape is already changing in that regard.
And Jay, did I cut you off there? Were you about to jump in?
I think Dan and you have it exactly right. I think the financial system is definitely in a much stronger place than 2008, 2009. But I think that means that this recession will be very different than that one. It's not a recession that the central banks of the world can fix by just adding liquidity to the system and moving it. Even if they had the flexibility. I don't think they do have the flexibility because, as Steve Ratton and Larry Summers pointed out, the only way to break inflation, and we haven't seen this kind of inflation in 40 years, is to raise interest rates and keep them above the rate of inflation. So that's going to have to go up. But the bottom line is this when it happens, will be a real recession. This will, and it makes sense when you think about it, because we haven't had a real recession in 15 years. So there's many companies out there that probably should have restructured over that time period that didn't because of the actions of the central bank. And now those companies and many others will have to deal with consequences.
You made the point earlier that as in so many other areas of sort of geopolitics and economics and the like, that the crisis takes a long time to arrive, and then when it does, it unfolds faster than anybody expected. And so, to your earlier admonition, Jay, you were saying that companies ought to be putting together the teams to, that are going to be the action-taking teams and have to be nimble on this and be creative on this. Now, are you seeing that happen? Are companies being proactive on that front? Or do you think that, despite the fact that we're all talking about all of this, that actually, the rubber's not yet hitting the road, so to speak, on this?
I think it'd be fair to say that the answer is yes. There are some companies that are being more proactive, but the truth is that none of them are being proactive enough. And I'll give you a perfect example. You go back to 2008, 2009, when Lehman filed. Right afterwards, without mentioning names, I did 3 or 4 of the largest restructurings in the world. And they were all $30, $40 billion deals. And I remember in one of them, I'd gotten a call from one of my partners who had said, we'd like you to meet the company. Everything seems fine. The board just met, but maybe third quarter of next year, there might be a covenant issue. To 48 hours later, getting a call saying, you better get down here right away. There's an interest payment due on Friday, and they're running out of money. And that gives you a sense of how quickly things can just devolve in these situations. So I think companies think they're thinking about the issue and think they're starting to get ready. But it's sort of like turning a large cargo ship. It takes a long time to turn it, but once it reaches a certain point, it moves pretty quickly. I think they should be acting more quickly because we don't know when the start date will be for this recession. Could be second half of this year, could be the beginning of 2023. No one wants to make a living predicting the start date for a recession, but it will happen, I believe, and I believe companies need to be a lot more proactive than they have been so far.
So you just brought up the point of debt, and Dan, earlier, you had talked about the sort of the draining confidence that is going on there, both at a corporate as well as at a consumer level, and that there are a number of factors behind that. Certainly, one of the major ones is inflation, and notwithstanding the fact that inflation is at its highest point in 40 years, there are transitory elements of that, but I think team transitory has been put onto the back burner now. A lot of this is more systemic. But perhaps more importantly, from a consumer perspective, it's actually a part of the national conversation now, right? Nobody's talking about their concerns about inflation for the last 35 years under an era of price stability. But one of the phenomenon of the era of free money and low and zero or negative interest rates, of course, has been the loading up of debt by corporations, which is completely rational action to take under that environment. And inflation obviously has a mitigating effect on debt, but obviously rates are going to be going up, perhaps at a more accelerated rate than markets had expected earlier, even this year. So, talk, Dan, a little bit about the corporate debt situation that we are in, and how that's going to be impacted by this changing environment.
So this is a sort of a fascinating question because, again, we can draw some real comparisons to 2009, both in terms of who is now providing debt versus 2009, and also the types of debt and the some of the features. And I will aim to talk to this in a sort of way that people don't lose me in jargon, but Kevin sort of prompt me if that's not the case. I think the most important point with regards to the provision of debt is that typically speaking, in 2009, if you were a corporate borrower, then you borrowed from either banks or from big funds with regards to the corporate bond market, and it was really quite straightforward. The market is now just so more complicated and sophisticated than it was, sort of 10 to 15 years ago. You have, the proliferation of the direct lending market. You have credit funds that bolted onto the side of private equity that's providing debt. You have very, very different structures and sort of much more complicated balance sheets. So that's the first point. Much more complexity and many more participants, all of whom have different aspirations and behave in different ways, particularly when the going gets tough. The second point is, particularly in private equity, the leverage multiples, i.e. the amount of debt that's in the balance sheet relative to the assets of the business, are much higher. And, one of the features of a very low or zero interest rate environment, Kevin, for the last 10 years, is that much more corporate confidence about taking on debt, and as a consequence, much more leverage in the market, which is great if you're a private equity investor, but tough when the market goes against you because you are dealing with a much bigger problem. And then I think that the third issue that I would identify is some of the terms of the debt that's been provided contain much more limited covenant protection or sort of control mechanisms in the debt. That means, it may well be some of these companies and clients will actually run out of cash before they default on their own covenants, which is almost diametrically opposite to the logic of how debt documents should be created. But because there's been so much supply of debt in the market because of all these new entrants, and so much confidence about taking debt on because of low interest rate environments, suddenly if you are a corporate borrower, you've been able to negotiate extremely tolerant debt facilities. That means that the controls don't exist. And the final point I would make is, if you look at the corporate bond market, which is clearly where a lot of corporate Europe and corporate America has been able to tap the debt markets over the last 10 to 15 years, the level of what we call speculative grade issuance, which is also known as sort of high yield or junk, is double the amount in March of 2022 than it was in September of 2008. And again, you don't need to be an economist or a banker to realize that, if you have got double the amount of speculative debt in the market, that means you've got many more businesses that have already been identified as having challenges or problems associated with them. And of course, when the tide goes out and all of these other factors that we talk about start to come to bear, they will be the businesses, that are at the sort of forefront of the problem first.
Kevin, can I add something to that? Because
absolutely,
it's an excellent point. I even go back a little further. So if you look back to the 1980s, when I was early in my career, that's when you saw all these companies for the first time lever up with high yield debt. Drexel was providing all these junk bonds to do all these LBOs and other acquisitions. And what happened was they all levered up. They were levered up way too high. And then the recession hit in 1991, and that's when we did all the early prepacks, because you had all these companies that were just over-levered, and they were good, healthy companies from an operating perspective with just too much debt. And that's when people first figured out, okay, if I have debt that sounds like equity, that has interest rates consistent with what equity would be, then maybe I really own equity. And if I own equity in a company that's over-levered by too many turns, then maybe I really just had a warrant or an option. And so I think you're going to see that same pattern, because I agree. Companies are over-levered. There's more debt on the balance sheets than ever before. And when the recession hits, it won't take very much for every one of these companies to take a look at it and say, I need to fix my balance sheet in order to survive.
So I want to come back to that, but I also want to pick up on something that Dan said earlier. You made the point, we have to learn the lessons from the last war, but not assume that the next war is going to look exactly like that one. And I think that that's something that most of us take on board. Where that oftentimes doesn't happen is in the halls of government. And I'm wondering what you guys think right now, because clearly, it's very clear that on the monetary policy front, right, the Fed is clearly behind the curve. But not only that, with the differing conditions that we see prevailing in Europe or prevailing in the UK versus what we're seeing we might not have particularly concerted action. The Fed is going to be more aggressive than, say, the ECB is, as an example in the near term. But when you hear what regulators are saying and when you hear what elected officials are saying, and obviously, when you close your eyes right now and you hear elected officials talking about corporate responsibility, it's hard to tell whether they're coming from the right or the left. The extremes are sort of the same in their anti-corporate corporate rhetoric right now. But, do you think that they have a realistic view and understanding of the phenomenon that you guys have just been describing out there? Or are they further behind the curve than everybody else already is?
I'm happy to start. I'll break it into two groups. If we're talking about our elected officials in Congress, I think history will show that they're way behind the curve, that they're always fighting the last war, and that both sides looking at the last war see it completely differently. So the good news is they're never going to reach agreement on anything. So I'm not worried about them enacting legislation that's going to change things. But what that really means is that it's up to the Fed and the other central banks to take action. And I think the Fed and the central banks are very smart, and I think they understand where things are. But I also think they're realistic. I personally believe that they're out of tools. Their tools are to add liquidity to the system, which is what they did after 2008, 2009, and keep interest rates at close to zero, which is what they did also. They've been doing that for the last 10 to 15 years, which has created this phenomenon where we've eventually avoided a couple of recessions and been able to push things forward. But with inflation as high as it is, the one thing we learned from what Paul Volcker did in the 80s and early 80s and late 70s is the only way to break inflation is to raise interest rates. So I think That's what the Fed and the central banks are going to have to do. And so I don't think they have the tools that they're going to need to be able to engineer the soft landing. I hope I'm wrong. I'm not looking forward to a massive long-term global recession. I'm just concerned that we're sort of in the middle of this experiment where we've kept interest rates at zero and we've kept liquidity in the system for 10 to 15 years. And now we don't have a choice but to change that. And I'm concerned that the next few years could be very difficult for companies around the globe as we work our way through it, despite the best intentions of the Fed and the other central banks.
Yeah, and one of the things that's concerning there is, and I think we've seen hints and bits of noise about this, but the independence of our central banks, and particularly the independence of the Fed, is not something to be taken for granted. I mean, they've had a fair degree of their own mission creep, but frankly, government and electorates alike, want them to do certain things, which is basically thread the needle perfectly. And when they don't, they come under pressure. And so, I think there is some fear out there that there could be, further political meddling or erosion of Fed independence over time. But guys, so clearly, you've set this stage where companies ought to be preparing themselves, even though there are a variety of potential trajectories we could wind up going down, depending on a whole lot of variables, not least of which is monetary policy, as Jay pointed out. So clearly, when times have been great and times have been good, and markets are going up and so on and so forth, I guess on a relative basis for the broad restructuring industry, both advisory and legal advisors and the bankers and so on and so forth, are relatively lean for the industry. But when the storm clouds start to emerge, and there's still time to head off, the restructuring scenarios, let's say, and the bankruptcies and so on and so forth. What is it? Talk a little bit about what the industry is doing right now, and what it's doing to gear up. And are you finding that the audiences are as receptive as they need to be to what you guys say are counseling your clients on right now?
So let me sort of jump in there, because I think a lot of what's happening in our industry is actually a function of what's happening in our market. So, and I'll talk to the European market and also a little bit about Middle East and Asia, and then they will no doubt cover off the US. Right now, the UK market for restructuring is picking up at quite a pace. A bunch of the issues that we talked about earlier, which are pertinent to all markets and economies, are really amplified in the UK right now. Energy being a good example, the emergence from COVID, supply chain issues, etc. So the UK market is really busy, and we are seeing that, in the behaviours of our competitors who are investing in this in a way that they probably weren't 2 years ago. Clearly, we've been through our own journey as a business, hence why we're on the call with you today. Because we recognise that there was going to be an exciting and an interesting market, and we wanted to position our business as well as we possibly could to be ready for that. I think, though, if we look at some of the other markets across Europe and Middle East, they're actually quite quiet. But we expect that they are going to become quite busy very quickly. So if I take Germany as an example, Germany's been an extremely benign economic environment for a long period of time. As a consequence, lots of M&A activity in Germany, very little restructuring activity. As it happens, I was on a call this morning talking about how we are going to plan for Teneo to be present in that market going forward, because we expect the German market to be extremely busy. It will be highly impacted by the war in Ukraine, because there's huge dependencies between the German economy and the Russian economy, particularly with regard to energy. But there will be many other factors that will create opportunities for us in Germany. Similarly, France just been through an election, as we know, over the weekend. There are already substantial warning signs coming out of the French economy that indicates there's going to be activity. Right now, our market, the restructuring advisors, fairly quiet, but we expect there will be significant activity going forward. And the final point I'll make is the Middle East, where, again, it has been a relatively quiet market, huge capital available, as we know, in the Emirates and in Saudi. However, issues emerging, some of it related to Russia, Ukraine, but actually not so much, but big issues with some of the other factors that we've talked about, and also legislative changes, particularly in Saudi, with the emergence of new legislation regarding restructuring and bankruptcy. And again, we expect uptick in activity in those markets going forward. And unsurprisingly, the financial advisory and restructuring businesses are now emerging to be ready to take advantage of, and provide advice to clients when that advice is required. I'll pause there.
Yeah, and Jay, how about in the U.S.?
I think it's somewhat similar. It's still been quiet in the restructuring industry. There's still a lot of liquidity in the system, and interest rates are still relatively low. But there is a sense that things are going to change, and so I think the leaders of the restructuring firms are starting to gear up. I think they're adding people, and interestingly, again, what you saw after 2008, 2009 is not only do you add people with restructuring experience, but you try to teach the other people you have in-house how they can be helpful in those situations. M&A lawyers or M&A advisors, corporate finance advisors, banking advisors, they're all very important in restructuring scenarios. And so with a little bit of planning, you can make sure that not only are you adding the right people, but that you're teaching the people you have in-house how they can play during those restructuring scenarios. One other thing that, it just occurred to me, the thing we haven't talked about is one of the real consequences of having gone so long since the last real global recession, because you had one in obviously 2008, 2009, but because of the actions of the Fed and the central bank, it happened so quickly, it went in and out. So when you think about it, it's probably been 20 years since the really last long-term recession. And what that means is that people that run companies, and the people that are making decisions on Wall Street have never really lived through a recession. And if you actually haven't lived through it, you don't realize how quickly things change, how quickly liquidity runs out, how quickly the finance markets close, and how important it is to be ready to react to that. And that's why the smart restructuring companies are bringing in their senior advisors now, people that who have lived through those cycles, and who can help guide their best clients so that they make it through.
So, guys, we've been talking a lot about the overall, the kind of the macro environment, and talking in to some degree in generalities. And I'd like to drill down a little bit, because one thing you've talked about, the differentiation of approach, somewhat predicated on the how forward thinking boards and managements are and whatnot. But I'm wondering if there's another way of differentiating here at all, and that is whether you're seeing real differences in position or how well positioned they are of different industries. And if you can shed some light on that. But also maybe we could do a couple of little case studies here by drilling down a little bit further, perhaps into what you're seeing in industries where you guys have particular personal expertise. And maybe, Dan, we can talk about the retail sector, and Jay, we can talk about the airline sector as two examples. But Dan, let me start with you in terms of what you're seeing in terms of industry differentiation, and if there's anything particularly interesting on the retail side.
Yeah, no, that's fine. There's probably three industries I'll call out, and one of them is retail, and so I will come back to the prompt. The three that I would call out are financial services with regard to Russia, secondly, the energy sector, and thirdly, retail. If I take the financial services with regard to Russia firstly, so, in terms of our own case studies and experience, so we have been appointed over 3 banks in London, which are branches of Russian entities, so it's public information. It's Sberbank, it's VTB, and it is Sova Capital, a direct result of the implications of sanctions and the war in Ukraine on Russian shareholders. So a classic example of how events overseas are impacting on businesses here, and where the regulators and the government have stepped in to protect deposit holders and other counterparties to these institutions to ensure that the sanctions regime does not cause consumers to lose and allows assets to be protected through this period of great change. And that's been very busy for us, and we expect that to continue, and there will be counterparty implications for other entities which are not necessarily owned by Russian shareholders and not necessarily directly linked to the war in Ukraine, but ultimately will need to be protected. So we expect financial services to continue to. I mentioned energy. The challenges in the energy market are well documented. I won't sort of go through the background, but observers will see that the UK has been heavily hit by energy costs and the energy markets globally, and in particular, we were appointed as special administrators of Bulb Energy. Many people will know the name. It was the 6th largest provider of energy into the UK market. We're running it in special administration. We're seeking to sell it. We've sought and received very substantial funding from the UK government to protect 6 million consumers in the UK who are drawing energy from Bulb. So another great example of a very specific industry. And there are many other examples in energy across Europe where either state intervention or bankruptcy tools have been used to protect consumers. And then the final area, and you prompted me on it, Kevin, is retail. Retail is a well-trodden path for the folks at Teneo. And we've been involved in many of these situations. Retail is fascinating right now. We could do a whole call on retail, and I'm assure you we'll keep this brief. But we spent the period up until and the beginning of the pandemic restructuring what we refer to as traditional retailers, so bricks and mortar retailers with shops, malls, sort of outlets, and we did huge amounts of work in that regard. Interestingly, we are now restructuring pure play online retailers. These are the businesses that until 2020 enjoyed huge meteoric growth and were cannibalizing the traditional retail market because consumers enjoyed the online experience. They enjoyed not having to go and drive to a shop. They enjoyed not having to pay for parking and all the other issues associated with it. Actually, you're now beginning to see an inflection in that. And those retailers who enjoyed that meteoric growth are now beginning to endure problems of their own. Some of them are supply chain, which we've talked about on this call. Some of them are distribution and last mile delivery and fulfillment. Energy costs are irrelevant because, suddenly fuel's more expensive and driving the van that delivers the package to the consumer has become more expensive. ESG is a big factor for these suppliers, retailers, because they need, to be able to demonstrate a very clean audit chain in terms of where they're getting their goods from. So lots and lots of issues. And again, we've been busy in that market, and studio retail in the UK, which many will know, a big online department store, was a restructuring that we did in March of this year. So they are some examples and some case studies, and those 3 markets and industries I would suggest are, at the top of most people's lists of sort of activity right now.
So since I've got you here, I just wanted to follow up on the retail sector on a sort of slightly separate question, because there's been some long-term trends that have been emerging independent of all of the recent dislocations and sort of brewing market conditions. And the week after next, I'll be in London really for the first time since the pandemic, so I don't have as good of a street eye view there. But as all New Yorkers know, retail on the street here is a pretty grim look right now. So even in the high trafficked Madison Avenue, Soho areas, a lot of stores that are just, for lease. And I know this is probably as much a commercial real estate as it is a retail question, but how do you see that how is that developing now? Where are we going to go on that front?
Yeah, it's a great question. And as you know, I was over in New York last month and I saw it for myself, how it looks now compared to how it looked 2 years ago before the pandemic. And many of those issues are also features in Europe, albeit, it is noticeably different in London in terms of the footfall in London, because I do believe in London and across much of the UK in particular, the return to office has been, quite dramatically different to other parts of Europe and possibly the US as well. And actually, I think that is the heart of the issue, Kevin, which is, if you are going to be an effective and successful retailer in any city centre, and clearly New York is at the sort of pinnacle of that, then you need customers. And actually, the issue that has been apparent in the last 2 years is customers have been at home, and hence the sort of shop environment has been very quiet. I think going forward, lots of things will change. You will see return to the office, but it will look different. You will have busy times of the week and quieter times. We may see, partial weeks opening, partial days opening in stores in certain sort of areas. We will see repurposing of real estate, and you mentioned real estate. That will absolutely be repurposed, and you'll see it much more experiential and destination, i.e., consumers will want to go and shop, but they'll also want to do lots of other things at the same time in order to make it sort of an outing. And in many ways, what we will end up seeing is the mall environment in the city centre, so that the consumer can sort of have a much more packaged experience, as opposed to having to sort of travel, drive, and work quite hard to do everything that he or she wants to do. So it will change, but in the short term, until we see return to office in a meaningful way and customers entering and using shops again, it's going to continue to be tough.
So Jay, I want to tap into your experience in the airline. Obviously, over the decades of your experience, talk about an industry that's had some ups and downs, and I'm no pun intended, I'm not just talking about takeoffs and landings here, but I mean, on the one hand, sort of compared to what Dan was just talking about with regards to retail foot traffic, it seems like everybody and their brother wants to get on a plane these days, and the demand is out of control. And we've even heard from airline managements, that their ability to historically pass through jet fuel price increases, now they just blow right through that, no problem. The consumer will pay. But obviously, you can't straight line anything. So how are you seeing the airline industry evolving in this environment, and what are you hearing out there?
Sure. Look, the airline industry has been a giving industry for restructuring professionals for as long as I can remember. I started working in the industry back in the 80s. I did Eastern Airlines. I worked on the Pan Am case. I did all the work for a company called Evergreen Aviation for 25 years. I did the America West restructuring after 9/11. I did American Airlines. So I've seen a lot of it, and I guess there's good and bad. The good is the airlines are very resilient, and there are fewer in number now with all the mergers over the last 20, 30 years, so that the ones that are left are pretty solid companies. And you're right, they've made it through the pandemic when there was a period of time when nobody was flying, to a point now where everybody wants to get out, everybody wants to travel, and they're able to pass along the costs. And that's great, and that's important. But again, things tend to run in cycles. If we're right and inflation's staying high, then and the consumer is really going to be impacted. And I think it's easy for people like us and people on this call to say, okay, inflation's high, that's too bad, and we go on with our life. But for a lot of people in the world, there's a dramatic impact. They really make decisions. Okay, I'm not going to take that vacation this year because I can't afford it. The price is too high. And the business travel, as much as we are starting to get back out on business travel, if the price for a business trip from New York to London is astronomical, well, then some people will say, well, why don't we just do this one by Zoom call? And so I think things have a way of going through cycles. The good thing for the industry is that I think we've seen, especially since 9/11 and through the last crisis and through the pandemic, that the governments recognize the industry as a whole is important to national economies and will support them through those crises. They did it after 9/11 with special legislation. They did it during the pandemic with special legislation. And so the companies themselves will do fine. But that doesn't mean that balance sheets won't need at some point to be reconfigured. Usually the price for that type of support is a fixing of the balance sheet. I've always said that I thought the airline industry, it's almost unfair, the kinds of decisions that boards and CEOs have to make. Because if you're sitting in a major airline, you have to decide, okay, should I spend $5 billion for new aircraft, which will be delivered in 5 years, which will be more fuel efficient and nicer. And so you have to make a judgment. What are people going to be flying in 5 years? Do we have another pandemic? Is the price of fuel going to be astronomical? Will we be able to pass it along? Or will the price of money be higher than the price of fuel? And you don't have to be wrong a lot. Be wrong a lot in the aviation industry. You're off a little bit, and all of a sudden your balance sheet gets turned upside down, and you're looking at potential restructuring scenarios. Again, I think the industry as a whole will do well. I think the companies are well run. I think their balance sheets are generally in good shape right now. But I wouldn't just continue to believe that they'll be able to continue to pass the cost along. If fuel prices stay at the levels they're up, or theoretically even go higher, at some point the consumer will balk, and things will go in the other direction. The other industry you guys were talking about was real estate, and I think real estate is going to be a busy industry over the next several years, both commercial and retail. Again, as Dan pointed out, lots of retail companies are changing. People don't want to go to the malls as much. People don't, and so we're going to have to reconfigure, what those malls are used for and what we use retail space for. And in the commercial sector, I think the pandemic has caused companies to reevaluate their need for commercial real estate space. If people aren't coming into the office 5 days a week as we used to, and we used to come in more often than that, but are coming in 2, 3, 4 days a week now, and maybe it's 50 to 60% on any given day or in the office, well, then all of a sudden you don't need as much commercial real estate. And all the real estate space that has been built, it's going to be hard to find new clients that will lease them up at the rates necessary to support the assumptions behind building those in the first place. So I think just like there was in the late 80s and early 90s, there will be a turnover on the commercial real estate side also. Again, beautiful buildings, beautiful facilities, just not able to pay the costs associated with it. So those are industries I would definitely focus on over the next 5 years.
Yeah, we've got just a few minutes left here, but Jay, I wanted to, Dan, I wanted to go back to, you brought up Russia, and you were talking about some of the sort of the very specific work that you're looking at. But one of the big phenomenons of the last several months has been the mass exodus of Western companies out of the Russian market, and it happened very fast. And there was a lot of self-sanctioning that went on. A lot of these companies left; they weren't required to by law. But now, as it looks like this conflict, this war, could be very protracted, the reputational elements of working in Russia, as long as President Putin remains in power, could remain in place for quite a long time. And not to mention that the contraction of the Russian economy means that the Russian consumer could be compromised for years, if not decades to come. So the second question now becomes, for a subset of those companies that left suspended operations, the assumption being that we're going to go back. At some point, they may now come to the conclusion that their operations, their assets in Russia now need to be disposed of or wound down or what have you. So that's got to be another potential emerging area of business. And I'm wondering what you're seeing on that front and what can be done. And there's going to be, I imagine, Jay, as well, this is going to keep the lawyers busy for decades to come. And it's also challenging because all of the professional services firms, the consultants and the law firms and whatnot have also all left Russia. So you don't have the same operational expertise on the ground there either. So how do you see that playing out, Dan?
Yeah, I think it's an evolving situation. The questions that multinational businesses were really sort of challenging themselves with in early March were, do we stick, do we mothball, or do we flee? The majority of larger businesses, and certainly those with sort of substantial brand recognition and reputational public interest agendas to grapple with, chose to mothball or flee. I think as ever, it's difficult to predict these things. My suspicion is those who chose to flee, not mothball, will probably be pleased with that decision, candidly, because this is going to last a lot longer, as you say, than perhaps it was initially intimated that it might. And the cost of mothballing is substantial. So, one of the features that we are sort of seeing now is corporates who initially concluded to mothball at their own cost are now beginning to re-emerge and sort of say, actually, we're going to flee. And we're going to sort of take our medicine right now, and we're going to deal with the issues, and we're going to sort of get out of Russia, because we don't believe it is economic to assume that we will be able to return in the short term. And it's difficult to predict what will happen in Russia, but it may well become some kind of a hermit state for a period of time. That means it is impossible to treat it as a sort of a counterparty in the same way as it was treated before the war. And I think to the point you made around professional services in Russia, it's a real issue. All of the big four exited, the majority of the international law firms exited, many of the other sort of consultants and advisors have left the market. I don't think they're going to go back in the short term, and therefore finding solutions has to be done outside in, because the experience and sort of knowledge doesn't exist inside the country, and that is further complicated by the sanctions regime, which clearly makes it difficult to act in some of these circumstances because of the legal complexities from either UK, EU or US sanctions associated with these countries. So it is incredibly complicated, but my summary of this would be those companies that chose to mothball 6 to 8 weeks ago are probably now concluding that it might actually be a flight.
And do you think that there would be a compelling reason, if flight is your choice, to do it sooner rather than later? Because as conditions worsen, that the Russian government could make it more onerous, especially if unemployment, say, starts to rise in Russia, and these mothballed workers, like, in other words, is it better to be at the front of that line than it is to be at the end of the line, because the terms and conditions under which you will be allowed to exit or dispose of your business could change, and not in a good direction?
Look, this is speculation or supposition on my part, but I think that logic has to be right, because there are no indicators or intelligence that's indicating that this is going to get easier in the short term. And therefore, I think through a combination of concerns around the complexity and also the sort of the Russian legal response, because clearly the Russian Federation is seeking now to sort of intervene and punish foreign corporates who are seeking to sort of manage their own affairs in Russia in a certain way. It has to be, the right logic on the outside looking in to say the quicker we can get out of here, the better.
And there's another reason why you'd want to make that decision sooner rather than later. You essentially want to take your medicine sooner. If you're a company that's going to have to write off significant assets, and it's going to affect your revenue, it's going to affect your leverage ratios and everything else. Frankly, if it were me, I'd like to, and that creates covenant issues. I'd like to approach my lenders earlier in the cycle, when we haven't gotten to a recession yet, and say, look, this is going on, nothing we can do about it. The rest of the company's fine. Let's fix our covenants and get prepared going forward. If you wait 6 or 9 months and we're already in a recession, when you're having to have those conversations, well, then my experience is your conversations with your lenders get a lot more difficult.
So we're about out of time. So let me just ask you guys one wrap-up question here, and I'll let you go. We're talking about this environment that we're moving into, but even before the war started, and one of the pandemic caused people to start really focusing on a lot of this stuff. Companies are, and governments are exhorting them to think much more about resilience, right? The resilience of your supply chain. In some cases, that means redundancies. If you're in a particularly sensitive sector that's sensitive to, say, Western powers and sensitive to China, there might be complete redundancy of supply chains in China, supply chain in the West. That might mean a different employee mix as you're building factories in the United States versus, say, building factories in Asia. we might be moving more from just-in-time inventory systems to having greater inventory on your balance sheet. And that's not even to talk about trying to meet your net zero or energy transition objectives and the like. Bottom line is, my point is that all of this is going to be incredibly expensive in an environment where capital is going to be less abundant globally. Are we setting up for this to get really quite ugly out there, in your view? Maybe, Dan, we'll start with you, and I'll give Jay the last word then.
Yeah, no, that's fine. I think there is going to be some of that. Now, I mean, whether it gets ugly will clearly, I think, be sort of fact and industry specific. But to give you one client example, I was with a client on Tuesday evening who is in the retail sector in the UK, who is designing a strategy which they described as the Beijing buffer. They are heavily reliant upon Chinese imports for the particular products that they retail. And they've chosen to accelerate their supply chain by 3 months this year to create the buffer. It's going to cost them a significant margin deterioration because there's an excess of demand and a lack of supply, so they're going to pay a premium to get the goods. They're also going to have to change the way the business is financed and funded because they'll need access to capital earlier in the year to be able to buy the goods and pay for them. But they've made the decision that they are willing to trade profits and also take on some more debt in order to avoid having empty shelves at Christmas. And that's just one example, and there will be many others. And actually, going back to the beginning of this conversation, where Jay was talking about scenario planning and preparing, these are the kind of difficult decisions that corporates will absolutely have to take in order to protect their businesses. And it may mean that they're less profitable, and it may mean that their balance sheets are not quite as strong. What it will mean is that they are future-proofed.
And I agree. Again, I think it takes us back to where we started. It's scenario planning. It's thinking about all these what ifs and beginning to plan for it. And yes, companies are going to have to change the way they do their just-in-time inventory and their supply chain logistics, and that's going to have a cost. And by the way, there's going to be a cost associated with additional cybersecurity protection that people are going to have to spend for. There's going to be all these additional costs that will cut into the balance sheet, that will cut into liquidity, and people need to think about these in advance and plan for them. So again, it's hard for me to imagine a scenario where most companies aren't going to face difficult times, but the ones that really plan for it now and begin to take steps like the ones we've talked about to be prepared for when it happens, those are the ones that will come through the cycle okay and come out the other end.
Well, hopefully that is the takeaway message to everyone on listening in today. So gentlemen, I want to thank you very, very much, both of you, for joining today. We've covered a lot of ground, and frankly, we could have dug into any of those subjects even deeper and gotten much more technical. But I think hopefully we've demonstrated the array of challenges, but that actually there are tools and there are things to be thinking about sooner rather than later before the music stops. So I want to thank everybody for joining me today. Jay Goffman in New York, Dan Butters in London. Thanks all. Have a great weekend. And until next time, I'm Kevin Kajiwara in New York. Have a great day.